Hello and welcome. My name is Alex Martin, and today we'll be running through third quarter fund manager report. Starting with the market review, global stocks continued their climb higher throughout the quarter. We observed strong performance in Asian equities, notably in Japan, which is benefiting from governance reforms and higher inflation, leading to a more positive investor sentiment. Emerging market equities were also strong performers. In contrast, UK domestic-focused companies and Europe lagged the market. A noticeable driver of equity market returns, particularly in the latter stages of the quarter, was AI enthusiasm. Risk assets were supported by the Federal Reserve's first rate cut since December 2024. The US economy remains relatively robust, with second quarter GDP exceeding expectations at 3.8% versus the anticipated 3.3%. This optimism contributed to a shift towards more risky and speculative allocations, including highly valued or unprofitable companies. The path for monetary easing in the UK remains less clear due to an ongoing inflation concerns and political noise around the Labour government's leadership. We saw UK 30-year gilts rise significantly, hitting a high of 5.748% after starting the quarter at 5.279%. However, we've seen this drop back to similar levels by mid-October, supported by easing fiscal concerns heading into the budget at a time where the market is pricing in more than monetary easing. Turning to the ethical MPS performance for Q3, portfolios generally delivered positive returns, ranging from 1% for the defensive portfolio to 3.98% for the adventurous. Equities saw significant momentum in emerging markets, where the UBAM Positive Impact Emerging Equity Fund was a standout performer, turning over 12.8%. This aligns with strong inflows into regions like China. We also saw notable returns in key thematic sectors, including Polar Capital Healthcare Opportunities and Robeco Smart Energy. The strong returns in alternative energy and semiconductors were particularly influenced by AI optimism. Furthermore, portfolios benefited from a strong rally in world healthcare exposure late in the quarter, particularly pharmaceuticals, following positive tariff and drug pricing agreements with the US government. On the defensive side, fixed income was largely positive, with global corporate allocations outperforming sovereign debt. Key contributors here were the T. Rowe Price Global Impact Credit Fund and the Rathbone Sustainable Global Bond Fund. However, not all exposures were supportive. Core global sustainable funds lagged the wider market, returning between 3.82% and 7.98%. The direct exposure to the UK and Europe also acted as laggards, largely detracting from performance. A key area that weakened significantly was infrastructure, with the RM Alternative Income Fund returning negative 5.2% due to pressure from rising yields and concern over UK fiscal policy. Despite this, infrastructure remains vital for diversification during periods of market weakness. Brighter World MPS experienced strong returns during the quarter, benefiting from the sustained climb in global stocks. Quarterly returns range from 1.61% for risk 3 up to 5.96% for risk 9. Portfolio's emerging market exposure within the core SRI allocation was the largest contributor to performance, returning 11.09%. Developed markets also saw strong growth, with Japan SRI returning 5.55% and UK SRI returning 4.46%. The X-Trackers Global SDG Fund, which focuses on sustainable impact companies, also performed strongly, achieving a return just shy of 9%. The satellite thematic allocation supported returns, led by the VanEck Semiconductor ETF, which was the standout performer, returning 18.41%. This reflected high demand for chips necessary for AI, alongside growing mergers and acquisitions activity in the sector. Other thematic funds like LNG Clean Water and Rise Environmental Impact 100 also contributed positively. In terms of defensive assets and real assets, property exposure returned 4.94%, led by broad returns, including AI-related real estate investment trusts. Within fixed income, global funds generally outperformed the portfolio's gilt exposure. In terms of positioning, no changes were made to the overall asset allocation during the third quarter. However, portfolios were rebalanced in October, which saw a reduction in fixed income to facilitate more defensive-focused equities. Recent strong performing allocations exposed to the AI electrification theme or healthcare have been trimmed back to lock in recent gains. Looking ahead, equity market confidence remains heavily driven by the AI growth story. Spending and investment plans from companies like OpenAI, close to $1 trillion, affecting not only the main AI names, but also the wider chip market, electricity generators, and even the real estate sector, where some data centers fall. However, there are a number of warning signals that the AI boom is now potentially a bubble, a risk highlighted by a growing number of tech veterans. Outside of AI, the economic outlook is more balanced, with weakening economic data and stubborn inflation continuing to complicate decision-making for central banks regarding interest rates. This is set against a backdrop of increased political noise, such as the budget paralysis in France or direct interference seen in the US. Upcoming budgets in the UK and France, alongside central bank decisions, be a key focus. The impact of tariffs that took effect since the spring is the big unanswered economic question. This impact is expected to become more evident as inventories build up ahead of the tariffs that are being used up. Despite these complex headwinds, we have quietly observed a recovery in key ethical sectors, notably in renewable energy, healthcare, and social housing. This reflects a beneficial spreading of risks and a search for opportunities outside the dominant AI theme, making the overall outlook for the next quarter far more balanced than what we have seen for some time, hence our desire to increase equity allocation. Our focus case study this quarter is Iberdrola, a Spanish energy company committed to driving the energy transition. For over 20 years, Iberdrola has focused on clean energy, aiming to reach 100,000 megawatts of renewable installed capacity for future development. The company's commitment is substantial. In 2024 alone, they invested over 4.7 billion euros into renewable energies. And they also have a global reach, serving over 100 million people across numerous countries, including Spain, the UK, Mexico, the US, and Brazil. Notably, Iberdrola already sells more than 11 terawatt-hours to tech companies and data center operators worldwide, positioning them as a leader in the data center electricity supply. In late July, Iberdrola announced a new joint venture with Echelon, an Irish data center company, to build and operate data centers in Spain. This development addresses a critical global issue. The recent expansion of AI necessitates the development of large data centers. These facilities consume immense amounts of energy, and currently, in the US and China, they're predominantly powered by dirty energy resources, specifically 56% by fossil fuels in the US, and by over 70% by coal in China. We're excited by this joint venture as it actively tackles this environmental challenge. Iberdrola is providing land already connected to the electricity grid and will guarantee a 24/7 renewable energy supply, sourced predominantly from solar power. Spain is ideally suited for this project, having established itself as a gateway for global data into the European continent, with over 70% of data traffic to Europe passing through. This is facilitated by Spain's robust fibre optic network, submarine connections, developed electricity grid, and the availability of clean and competitive energy. Thank you for watching. If you have any questions regarding the quarterly report or the recent rebalance in October, please contact us.